Welcome to Making Money. This is Matt McCall. Thanks for joining me. It is July 13th, 2023. And in the last couple of days, we've had two inflation numbers, the CPI and the PPI. We're going to break those down and tell you what it means for you and what it means for your investments, because the Fed will likely base their future decisions off these numbers we just got. And I will tell you, they're getting better, but maybe not good enough. Find out all the details coming up right now on Making Money. Folks, the AI mania has taken the market by storm. Goldman Sachs says 300 million jobs could be affected. Others say it will create trillions of dollars in new wealth. In fact, it's already propelled chipmaker NVIDIA become the newest member of the $1 trillion club. Now today, the global race to find ways to commercialize AI and turn it into profits is officially on. Of course, regular listeners should know that I'm a big believer in the future of AI. It has the potential to revolutionize the world as we know it. Just think back to when internet was created in the 1990s and how groundbreaking that was. However, you sure as heck don't want to just blindly support that AI trend, which is why I'm excited to announce that two regular guests on my show, Wall Street legends Mark Chaikin and Dr. David Eifert, are teaming up for the first time ever on July 19th. I urge you to tune in and consider what they have to say carefully. Just head to AI Race 23, that's the numbers 23, for full details. The one decision you may need to make with your money right now, even if you don't realize it. And why 2023 will be remembered as a year of the great AI race. With over 90 years of combined investing experience, there's nobody better to cut through the hype, answer all of your most burning questions about what AI really means for your money, and help you find the real opportunities to position yourself to grow your wealth as the story accelerates in the months ahead. Again, Mark and Doc will go live on Wednesday, July 19th with all the critical details. You do not want to miss this. You can head to AIRace23.com right now to make sure you're on their list for updates. Again, that's AIRace23.com. It's 100% free. Again, this is Matt McCall. Thanks for joining me. It is the 13th of July, 2023. Over halfway through what's been a really good year for the stock market here in the United States. Even abroad too. Japan's had a hell of a year. China's lagging a bit. India's had a good year. Some of the South American countries doing very well also. So overall, a pretty darn good year for stocks. But today's show is all about inflation, interest rates, and the Fed. We had the inflation numbers, as I mentioned, come out this week. The latest one was the PPI, the Producer Price Index, came out this morning. We'll get to that in a minute. The little bit more important one is the Consumer Price Index, a CPI. That came out earlier this week, and that is a number that the Fed will really look at. They look at what's called the PCE, but the CPI is very important and will drive their decisions on whether to continue to halt any interest rate moves, which they did the last meeting, or in 2 weeks from now, decide to raise interest rates again. I will give you a bit of a hint. After the number came out yesterday, the odds are still that the Fed will raise interest rates by 25 basis points at its meeting in 2 weeks. And we'll talk about that more in a minute. But let's they got to dial it back a bit and go back to the CPI, the Consumer Price Index. And these are the prices as it says in the acronym there, CPI. That C stands for consumer. So these are prices that we pay as consumers. Month over month, the headline number was up 0.2%. Year over year, up 3%. These were both below expectations. And that 3% number was the lowest number since March 2021. So over 2 years. And the headline CPI number has now been down 12 consecutive months, going back to last June. Again, this is June's number. Last June, when we had the headline CPI at 9.1%. So keep that in mind, that we are coming down. Then we have the core CPI. And the core CPI was also up 0.2% month over month and up 4.8% year over year. This, again, the 4.8%, the lowest level since October 2021. So not quite 2 years, about a year and a half, a little bit more. The core CPI is everything that's in the CPI. It takes out X food and energy, because food and energy tend to be quite volatile. So that people look at this as a little bit more stabilized number without the month-to-month noise that may be involved. So obviously, both of those numbers are still above what the Fed is shooting for, which is 2% inflation. Just to give you an idea, though, if we take a look back to where we came from, that the CPI reading of 3%, just slightly above the 2.9% average of level of inflation that we saw 2 decades prior to the great financial crisis, which we know is 07, 08. So for the 2 decades prior to that, things were fine. And the economy is, obviously we had a bit of a boom in the 90s, but then we had a little bit of the tech bubble. But overall, we had dealt with 9/11. The economy overall was pretty good. It was average 2.9. We're at 3 now. So to me, 3, we're great. The Fed may not think that, but for right now, I'm happy with where we're at. And I know I bashed the Fed a lot. We're going to talk about more about the Fed in a second. But what they're doing is actually working. I still think they went too far. Again, we'll talk about that in a minute. But within these numbers, what we need to realize is shelter, homes, obviously roof over your head, still remains a bit hot. Month over month was up 0.4%, year over year up 7.8%. And if you break down the number, shelter contributed 70% of the CPI number in June. So shelter needs to come down. And rent prices and home prices have been coming down. And I'm going to show you a chart here real quick that shows you that. As you can see here in this chart, I got this from Carson Investment Research. Ryan Dietrich over there posted on Twitter. It shows that shelter inflation is turning lower. And you can see that the one that peaked up there at 18% November 2021 or 2021. That's the apartment list index prices. Look how much that, it's up 18% year over year. Now we're down to 0. But then we look at the CPI numbers. The two components here of shelter, rent of primary residence and owner's equivalent rent of residence. That continued to move higher as the apartment list, which is a true real numbers, has gotten crushed. And I've been telling you for months that shelter is a lagging indicator. And it is. But we're starting to see it turn over finally. So as that number comes down, I just mentioned to you, it's 70% of this past month's CPI number. If that 70%, that huge part of that rolls over, I don't know if it falls like we saw the apartment list index fall from 18% to 0, but it's going to drop, folks. And as it drops, it's going to bring CPI down with it because it is such a large number. So keep that in mind. I know I've been saying this for months, but I really do believe that is something we need to keep an eye on. Used vehicle prices have been coming down. That was a big component of when prices were going up, especially during the pandemic. We all know you couldn't buy new cars, so you had all these used cars and prices kept going through the roof. Energy, obviously gas and oil and all that stuff, down 17% year over year. Gasoline within the energy number, up 1% month over month, but down 27% year over year. Food remains high. Food prices up 5.7%. Food prices 5.7% year over year. Grocery up 4.7%. Food away from home up 7.7%. But the numbers are lower than they have been in the past. I will give my one PSA here by looking at these numbers. Groceries up 4.7%. Food away from home, takeaway, parivar, as they say here in Spain or in Spanish, up 7.7%. Cook at home, folks. I do. I made last night. Granted, it may have been a frozen pizza, but I made food last night at home. I got the grocery and brought it home. So again, it's healthier. So eat at home. It's going to save you some money. Another number, when again, just kind of showing these numbers within here, what's really moving this. Prices for services, if you exclude energy, rose just 0.3% in June. That's the lowest uptick since September 2021. And on an annual basis, it keeps coming down. It's now down to positive 6.2%, but again, the lowest since August 2022. So that means services are coming down, which is important. If we strip out shelter, the core non-housing services index rose just 0.1% from the prior month. So again, all these numbers are pointing in the right direction. I thought this was a pretty fun fact. Last June, we were at 9.1%, and now we're down to 3%. So a huge drop. And this is that number last June was the highest number since November of '81 when I was 5 years old. And I kind of remember this music video on MTV. If you tell me what song was top of the charts there, I'll give you 1 second. I'll give you one more hint. A lot of women in leotards. I can picture it in my mind right now. Olivia Newton-John's Physical was top of the charts in '81 of November the highest level of inflation prior to last year. I thought that was good. For all you young folks out there, she was the girl in Greece with John Travolta. You've probably seen that. After the numbers came out, of course, we had to have some input from the White House. And again, when it comes to politics, folks, I think both sides of the aisle are completely effed up. Part of living down here in Nicaragua right now is nice because I don't have to listen to the politics that people have. But President Biden came out and on Wednesday after the CPI number came out, and he said, that's Bidenomics in action. Bidenomics is a word that should be eliminated from anybody's vocabulary. But he also came out and said, today's report brings new and encouraging evidence that inflation is falling while our economy remains strong. The only thing I have to say, again, this is not political left or right. Nobody, I don't care who you are, you could be my best friend running the White House right now, should not be taking credit for inflation coming down, because inflation hit the highest level, as I just mentioned, since 1981 under your watch. It's going to come down. So, and really, you should have nothing to do with it. It should be the Fed that's doing this. So, again, please ignore what the politicians say, because they're just going to feed you nonsense that doesn't make any freaking sense at all. So, the PPI came out this morning. It's producer price index. So, is it more the wholesale prices that came out? Pretty amazing numbers. The U.S. PPI year over year in June up 0.1%. In May, it was up 0.9%, and it came in lower than expected. So only up 0.1%. I'll show you a chart in a minute of that versus CPI. Smallest pace since August 2020, which of course was still in the heart of the pandemic, and down from the, in an all-time high. So this was a high number as well. In an all-time high of 11.7% year over year in March of 2022. It's now down to 0.1%. The core also getting rid of food and energy was also up 0.1%. Month over month, and year over year, it was up 2.6%, lowest since March of 2021. So these numbers continue to come down. And when I look at CPI versus PPI, I'm going to show you a chart here right now. Here's CPI versus PPI going back to 2011. You can see how high a PPI was. That's the white line. And then you can see the yellow line here, CPI coming down to 3. Another one I just mentioned, 0.1%. The PPI is the wholesale prices. That's the prices that it takes to put goods together, and then they sell it to you. In a perfect world, as that comes down, should be a little bit of a lag. Then CPI comes down because obviously the producers of these goods should not be charging as much. That doesn't always happen that way. Sometimes some prices can be sticky and they charge the same, or they are higher profit or whatever it might be. But I want to show you a chart that PPI came down very quickly, and CPI is following right in its trail right there. So I think it's going to be down just as quick. Some key numbers looking at PPI. The cost of goods, they were actually unchanged in June because of lower food prices. Food prices have now fallen 6 of the last 7 months and are down 12% over the past year. These are the wholesale food prices. So that's good. That should equate to lower prices at the grocery store at some point here in the near future. The wholesale food prices, again, like you won't see this because it's not there yet. As I mentioned a moment ago, groceries are still up 4.7%. So that should start to come down. You combine that with shelter coming down, CPI should continue to move lower. The wholesale cost of partly finished goods was down 5 consecutive months, now down 9% to a year earlier. So again, the goods that are partly finished that are getting ready to move to the finished product area, which then makes its way to retailers and then makes its way into your homes, and you pull out the wallet. Hopefully those prices continue to come down. So again, moving in the right direction here. One other chart I want to show you is this is the core services less housing. You can see the blue line, it keeps going up, and inflation will go up over time. But what you see here, the lower line shows the rate annualized change. Look what it was. It was up to nearly 10%. We're now down about 1.4%. And you can see what the average is going back to 2012. So basically going back about a decade, it's now below the average of what it's been. So again, the rate of the increases are going down much lower, which is a good thing in my opinion. And I lied. One more chart. And this really doesn't mean much, but it's something that I always find funny. They call it the misery index. It's a CPI year over year change, which is 3, plus the unemployment rate, which is 3.6. So it comes to 6.6. And this goes back to the late 40s. You can see there's been times where CPI is high, unemployment rate's high. Those aren't good times. I try to do a bit of a correlation with this to The stock market, there's really not much. I just kind of showed it for fun that there's actually something called the misery index. And apparently the misery is not too low. You wouldn't know that listening to the media in the United States or listening to your neighbor complain about things, but tell them, hey, listen, quit your complaining. The misery index is only at 6.6, one of the lower levels that we've seen on average over the last several decades. So it's not as bad as you may think. Let's move on to the Fed. Then I want to talk about the stock market and how this affects you. The Fed is still expected in two rates to raise interest rates by 25 basis points, 0.25%, after pausing and after going higher for 10 consecutive months. It did pause. What this means for you, I don't think it's necessarily going to mean your rates on your credit cards are going to go up that much more. I think what it means more is they're not going to come down as quickly as they may in the next year or so as interest rates start to roll over and the Fed starts to cut interest rates. Same thing being said for mortgage rates. I think mortgage rates, I don't think will go up much more because I think a lot of this is baked in the cake. But again, what it does mean is that it likely you won't see mortgage rates roll over anytime soon. So keep that in mind if you're anticipating trying to buy a home. Again, I'm not an expert on real estate by any means, but I do believe that we will see interest rates remain elevated, especially mortgage rates and probably credit card rates, borrowing rates at that point, and probably not roll over till next year. And at this point, I don't think the Fed lowers interest rates in 23 unless something dramatically changes. We have some type of hard landing that we see between now and the end of this year, next 6 months, likely early 2024. I think we could see that. I think a lot has to do with inflation, has to do with wages. Just on wages, I forgot to say this earlier, real wages, which is the wage increase minus the inflation, because that's the real increase. You take your increase and minus the inflation, was actually up 1.2% year over year. So now we're getting to a point, it's been negative for a long time, to a point where the wage increases over the last 12 months is actually outweighing inflation. That's a good thing. And that's a really good thing. The Fed may not like that because it may think that, well, okay, this is actually not good, that people, as higher inflation will lead to higher real wages will lead to higher inflation because there's more money. There's a lot of ways to look at it, but it also means that inflation is coming down, which gives you higher real wages. So it's kind of the 50-50, both ways you look at it. I think it's great because it's now people are actually making more money at the end of the day, taking away the higher costs of goods. So that's a really good thing. So I want everybody to feel that way, that they can go out there and buy what they need and not worry about inflation hurting that. So that's kind of where we stand with inflation right now. I think it's going to continue to move lower with the Fed. And now let's take a look at the S&P 500. You can see here the S&P 500 is trading right now today up about 0.5%. We're a few hours into trading, about 2 hours into trading. And this is a new yearly high. It's more than a yearly high. So things obviously are doing pretty well. And if you ask most people, like these bears, I follow a lot of the bears. I have for decades, and they're worse than broken clocks. They're right not even twice a day. Broken clocks right twice a day. A bear many times will not be right that often, and they will take their victory laps, and people pay them money to be on TV and for their newsletters and all this stuff, and they're just bears. Not only when you bearish are you losing money because you're likely the market's going against you, you're short the market. You're also losing out on the opportunity cost of it moving higher. So if you're losing 30% because the market just went up 30% and you're short it, you're also missing the 30% it went up. So you're actually losing out 60%. And the other thing to remember is, again, the market goes up over 7 out of 10 times yearly. You're fighting in such an uptrend that who are you to tell me you could pick that 30%? It's such who sits at a table at a casino when you have a 30% chance of winning? And I think it's actually a little bit lower if you really ran the numbers a few different ways. It's more like probably 25% chance. Those are horrible odds. So again, the market moves higher. Does it always move straight up? No. But I like the action that we see here. Obviously, it's hitting a 1-year high, the S&P 500. Here's a chart of the QQQs, which is the NASDAQ 100, the 100 largest stocks in the NASDAQ composite, X financials, again, hitting a 1-year high. And I'm going to zoom out a little bit just to kind of give you a bigger perspective of kind of what we're up against here. And you can see the all-time high was back in November of 2021. That intraday high was 408.71. Let's call it 409 on the Qs. And we're at 376 and change, so let's call it 377. So that's about what, 23, 32 points away. That's less than 10% away from a new all-time high in the NASDAQ 100. And you will say, well, that's being led by the Magnificent Seven, a big name. Sure, I will say that. But let's look at the S&P 500. It's not the same type of breakdown. It's all-time high going back to, I think it was the first week in January of 2022. 480 on the SPYs. We're at 448. So again, you do the math. It's like 32 from here, right? 32 points from here. It's less than 10%. So again, folks, if you just read these headlines and you just thought about inflation and the Fed and interest rates and how bad the economy is going to be and this recession that's been coming for 24 months now and our terrible politics that we have in the United States and everything else, you would think that the market has been going down. And I will tell you one more thing. If you follow these people, and not just for fun, I follow the bears for fun, to laugh at them and make fun of them. I know it's horrible to say, but I do that because I think they bring a huge disservice to the individual investor. If you follow them, you take their advice, and they're perma bears and have been bearish for many, many years, but they got the pandemic right. Bullshit. They didn't get the pandemic right. They had no idea a pandemic was happening. And also, when that pullback happened, it happened in a matter of about 4 weeks and became the greatest buying opportunity that we have seen in the last decade plus. And I was there recommending stocks to buy at that bottom. It's all documented. So that's number one. They didn't call it. And I tell you what, they wrote it right back up as they were still negative to the new all-time high. Oh, they called this last one. Maybe they did. But again, we're within 10% of an all-time high again. It's just very difficult to be bearish. Stop following them. They're going to, not only will they ruin your portfolio, they ruin your psyche. Negativity gets you nowhere in life. I don't know one successful person who's negative. I take that back. Maybe a couple, but they've been ostracized by their so-called friends and by their colleagues, and now are spinning their wheels, being angry and negative. That's what happens to people like that. They end up living a sad and miserable life. Money doesn't matter. They're just sad and miserable. So please don't be negative. We have to be positive here. And when it comes to stock market investing, I get laughed at for being an optimist sometimes, but I'll tell you, again, I'm playing the odds. It's not just me being optimistic as I am on life. It's just me playing the odds that the market goes up majority of the time. So I'm going to look for stocks to go up. And it's been a hell of a year so far. And I think it's going to continue for the near future. And I think, in the next 10, 20 years, we're going to have one hell of an innovation boom. Will we have recessions and bear markets on the way? Hell yeah. Of course we will. But the path of least resistance is higher when it comes to the stock market. No matter what I just talked about with inflation, no matter what I just talked about with interest rates or the Fed. The Fed is going to be here and do things for the next 20 years. If you base your investment decisions off the Fed, you're absolutely bananas. Unless you're a trader. And that's not me. So that's up to you. But folks, thank you so much. I hope you enjoyed it. So we got a little bit out of it. Again, there's 3 pillars. We want to have some fun. We want to educate you, and we want to make some money. Next week, we got a couple of great interviews coming up. One of my favorite colleagues coming on the show. We'll reveal that next week. Talk about artificial intelligence. We're going to dive all into that next week. Until then, have a great, safe, happy weekend. Go out there and give somebody a hug. Spread the joy, folks. Thank you so much for watching. I'm Matt McCall, and this was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.